welcome. You're watching ET Markets. I'm Tanya Aneja, and today I'm going to be joined by a very special guest. Well, he's the founder of Finology Ventures, and he's also a finfluencer with over 4 million subscribers on YouTube. Well, we have with us none other than Pranjal Kamra. Thank you so much, Pranjal, for joining us on ET Markets.
Thank you so much, Tanya. Thank you for considering me worthy. I'm really excited. Hopefully, I'll be able to add value to your view.
Pranjal, the investors on Dalal Street have been on a roller coaster ride, I would say, since the beginning of this year. And the market continues to remain in control of bears only. So how are you approaching markets at this point in time? And also, is the worst behind us or is there more pain ahead?
The word that you use, that investors, what the investors are feeling, they're feeling jittery. I'm an investor myself. I don't trade intraday, short-term momentum and all of that. And as an investor, one of the core disciplines that you have is that you only worry about controlling the controllables while completely ignoring the uncontrollables. So as an investor, what can I control? I can control the company I am investing in. I can control my asset allocation to it, but I can absolutely not control when the price will move or what the broader markets are doing. So, investor by definition means you can stay invested for minimum of 5 years. And, if we take a 5 year, if we backtest what all happened in the last 5 years, GST happened, demonetization happened, COVID happened, Brexit happened, and whatnot, which in the medium or short term looked like game-changing events, major events which could crash the market. But if you broaden your horizon, if you're willing to wait, if you're willing to bear the pain in the short term, we understand, that these events did not turn out to be as big a factor as it looked back then. So in the long run, most events which look really terrifying, right now, inflation in the US, even in India, looks terrifying. FIIs taking out money looks terrifying. But all of that is blown out of proportion in the present context. If we just zoom out, if you don't have to sell today, why worry about today's problems?
Absolutely. And also, Pranjal, where should one invest for better returns? I mean, do you think bank fixed deposits are now looking more attractive than stocks? And also, if you can share any strategies that investors should follow, especially at this point in time?
Right. So, again, adding to what I said previously, if anyone has a horizon of more than 5 years, then, you can be pretty sure that stocks directly or through mutual funds. So equities is the best category if your horizon is 5 years or more. No asset class in general will be able to beat the returns that equities offer. But of course, if your horizon is lesser, say you need money in a year, in a couple of years, then yes, FDs are a no-brainer. Because in 2 years, you don't know what real estate will do, with what gold will do, and your needs are arriving pretty soon. So 2 years, less than 2 years, FD is pretty much your only option. Definitely go towards that. Secondly, adding to the question, someone who has invested his or her retirement corpus in the market, say someone who's 55-year-old, 60-year-old, and all their cash flows, past cash flows in the form of savings, is now invested in the market. So if the market corrects now, they won't be having incremental cash flow to average it out. Absolutely. So for someone like that, whose future cash flow outlook is not bright, probably it's good time to shift from stock market to FD or gold. Whereas, most viewers who'll be watching this program, probably under 40, 45, at times on social media, my viewers are under 25, 30. People who have just started their career, most of their cash flows will be in the future. So even if for the next 2 years, the market doesn't do well, they'll always have incremental cash to average out their holdings, and their salaries will increase, their earnings will increase. So 5 years down the line, your current investment corpus will become insignificant in most cases because your salary packages have doubled and you always have incremental cash flow. So those people don't need to worry at all about what the market is doing. Only if you are nearing retirement, should you consider taking partial exit.
Well explained, absolutely. So, where do you see value in the market at this point in time, and which sectors are you betting on after the recent corrections, or maybe the sectors that look attractive amid the rising rate scenario?
Right. Again, a little contrarian here, Tanya. In daily life, also, we only understand value about things we have experienced. So, if I have never bought a t-shirt before, and this is the first time I'm entering a shopping mall trying to buy a shirt or a t-shirt, I wouldn't know if 1500 rupees is cheap or costly. It comes with experience, comes with my friends telling me, comparing brands, wearing some brands, and then I have the actual knowledge required to identify value. First time I cannot identify value. So rather than trying to identify value in the broader market, a common investor will never be able to do that. So it's first important to understand what your strength is, which is the sectors you understand. It could be because of your education, because of your passion, a club or a community that you have joined, maybe because your family members run a business that's similar to the business listed. Maybe they are working in a company in a sector through which, growing up, you have heard stories about the companies or the sectors. So you can only identify value if you know a particular industry inside out. And, if we think deep down, we all have a couple of such industries. People watching this program, I'm assuming they are at least 18 years or above, somewhere around that. So we know a couple of industries. If nothing, we know about bikes, clothes, probably beauty products, gadgets. All of us use that as consumers. So sticking to industries that and only then can you identify value. Because if we venture out of our circle of competence, often what looks as value is actually value trap. If you look at, and this is just for examples that I'm quoting names, not a recommendation at all. Just to look at a company like Castrol. 5 years ago, leader in the lubricant market, looked great, no problems in fundamentals whatsoever. But the future is EV. And that is where the lubricant business market is not sure about. So it's cheap. It looks cheap. But is it a value trap? The market currently thinks it's a value trap. So most of the times I hunted for value a lot. And whenever I tried doing that, I fell into a value trap.
Okay. And Pranjal, your thoughts on all the new age internet companies? I mean, a lot of investors have put in their money, and shares of Paytm, Zomato, and PB Fintech, for instance, have corrected significantly. So do you think now is the time to step in, or one should avoid these stocks?
Right. I would mention a couple of good things and a couple of bad things about these companies. One good thing, and I'm really happy that these companies got listed, is because, these companies, in my mind, will make a lot of Gen Z interested in the market, because these are the companies these young audience can connect to. So when in 2012-13, I was entering the market, I was struggling to find companies that I used as a consumer. And then I would invariably ask my father, oh, Parle is not listed. I'd be disappointed. Oh, Patanjali is not listed. So anything that I used as a consumer was not listed. And it's very important that, if you want to add the younger demographic into the market, there are options available in which they want to invest. So in that sense, Nykaa getting listed, Zomato, Paytm, Policy Bazaar, all of these brands getting listed is a huge, huge positive. Flip side to it, you got to ask that if these companies are so good, either why are the investors exiting, or why are they resorting to raising money from the public? Why is SoftBank not willing to put in more? If they have put in so much, why not more? If they are so bullish about it. So most, selling my company to the public is like selling my land. If I want to sell my house or my flat, I wouldn't sell it for a bargain price. I want the maximum price that I can get for my property. It's the same for IPOs. People who have built the business for 5 years, 10 years, it's their blood, sweat, life, everything. They wouldn't dole it out to public for a bargain. And it's not wrong on their part. It's natural. It's wrong on our part to assume that it's a bargain just because it's popular. And I want to buy everything popular. You cannot own everything popular. So in that sense, these companies have given a lot of valuation shock to the public, 50%, 70% correction. So that's a little disappointing, but that was wrong on our part. In general, what do I think of these companies? I think I cannot, paint these companies in a single category. In fact, this is my problem with how a lot of investors analyze IT sector as well. We sort of club IT completely, all IT companies in one sector, and these digital SaaS or consumer tech companies in one sector. Whereas, they could be as different as sky and land. For example, most people would have invested either directly or indirectly in, say, Tech Mahindra, Infosys, HCL, and TCS, and we sort of club them together as IT companies. Whereas someone who's bullish on healthcare and cloud should invest in HCL because that is how they derive their revenues. Someone who's bullish on telecom should invest in Tech Mahindra. That is how Tech Mahindra derives revenue. Someone who's bullish on banking should invest in Infosys. Whereas we simply club them as IT. Similarly, Nykaa is consumer tech, Zomato is consumer tech, Policybazaar is consumer tech, but their future and their outlook is completely unrelated to each other. There are, I would say, these are derivatives of their future, of their real world industry. So Nykaa depends on how bullish someone is on, disposable income rising and wallet share of beauty products rising. Insurance, how bullish are you on increasing penetration of insurance? So these are very separate companies, and thereby I don't have a singular opinion on them.
Absolutely. Thank you for explaining it so well, Pranjal. And now let's come to FII's outflow as well. I mean, FIIs continue to offload stocks in the Indian market. So why are they actually exiting the Indian market? What is pushing them away? And given that the valuations are now more reasonable, do you think that the pace of FII selling could ease going forward?
Honestly, Tanya, I don't track all of that at all. So I'm not an expert on tracking FII activities and trying to analyze what that means. But broadly, to make people understand that why I don't track this. I don't track this because probably I don't consider it very significant an activity to be trackable. So what's my thought process behind it? So a lot of FII investors are hardcore algo investors. So if they feel that by taking this much X amount of risk, we are getting returns X plus 2. As soon as they find that, okay, my FD rates in my home market have now increased by 0.5% or 1%. So that X plus 2 return that I was getting, it's now X plus 1. Because the base returns that I'll make in my home market are now more attractive. And so my signals, my algos tell me that the risk reward ratio is not favorable. And thereby, even if the individual, the fund manager thinks that there could be some pockets where money could be made in India, they need to justify to their investors, to their shareholders arithmetically, why did they still choose to take that risk when FD rates in my country rose? So most of the times, what we think is that FIIs are doing it independently, but in reality, their hands are tied. It's like an index fund. If HDFC moves out of the index, you cannot say, why did HDFC index fund sold HDFC stock? HDFC as an AMC is negative on HDFC. No, their hands were tied. It moved out of the index, they had to sell it. With FII investing, a lot of times it's the same case. Their hands are completely tied. They have to move out if certain events happen. And you also have to think that we cannot just take a 2-point view of the world that this happened in US, so this happened in India. There are, for FIIs, they have probably 100 markets to invest in. So they are not just valuing India against US, but India against Brazil, India against Indonesia, India against Malaysia. And probably they buying more in India or selling out of India at times could have nothing to do with India or US, but could have to do with something becoming really good in Indonesia or Malaysia temporarily, which is why FIIs change their behavior every quarter and there are no long-term signals from that.
Absolutely. And also, Pranjal, according to you, let's say, what will be the 3-4 top mistakes which investors should avoid at this point in time?
Right. In a volatile market, if you are really bullish on a stock, what tends to happen is that all companies correct. It's a broad market correction. So you bought something at 100, it's now at 80, a week down, it'll be at 70, and you keep averaging it down endlessly, which in my mind is overconfidence, because then you are saying that no matter what happens, I am right. Whereas even the best investors are right 60-65% of the times. So even the best investors, 10 stocks they pick, 4 turn out to be wrong decisions. And I mean, most of us, we are not stock market, really experienced stock market legends. So we are prone to making 50% mistakes. So when you endlessly average down a stock, you are saying that, okay, market might be right 60% of the time, I am right 90% of the time. So here this discipline comes in, that no matter what happens, in one stock, I'll never invest 10% of my total portfolio. One stock will not cross 10% of the threshold. This one discipline will, ensure a lot of people don't go out of the market. They always have the essential capital to stay afloat. And market is about staying afloat. If you stay afloat, index also gives 14-15%. So if you stay afloat, you will get 15%. Problem is we don't stay afloat. So that's the biggest problem. The next problem to me is hunting stocks with anchoring in mind. So you don't know anything about the company, but all you know is you saw this company 2 months ago trading at 1,000, and now it's available at 200. So it's very cheap. It's 80% cheap. So we don't know anything about the company. You have not invested previously in the company, but just because you have that 1,000 rupees price anchor in mind and now it's 200, you think someday it will go back again to 1,000, which will not necessarily happen. Companies make all-time highs all the time and then never go back to it. So that anchoring, I suffered a lot from that. I remember a company in my initial years trading at 60-70 rupees. I checked its all-time high. It was 5,000 rupees. And I just assumed that, even if not 5,000, if this could go back to 500, I'm buying it at 60-70 rupees. So that is a very common mistake. So if someone can avoid these two mistakes, they'll be good.
Absolutely. And before we let you go, Pranjal, your advice for all the new and especially young investors, I mean, it's a tough market right now. So what should investors do at this point in time?
So because buying and selling is so easy these days, we are, and if we don't do anything, so in fact, a research was done on soccer that, and it was realized that goalkeepers in penalty shootouts would often dive left or right. Whereas if they stay in their place, they would save 1/3 of the goals. Okay. But from the goalkeeper's perspective, we have to understand that if he stands there looking like a fool, and there are goals happening his left and right, he would assume that he's not doing anything. And probably the audience and commentators would also say that at least he should move. Whereas statistically, he's doing the right thing. So I think that happens in investors as well. If the market is falling and we are not doing anything, we assume that we are being lazy, ignorant, and things like that. We start self-doubting ourselves. Whereas in most cases, not doing anything is the right thing to do. So with so much volatility, I know it's really difficult, but that's the right thing to do. Don't over-juggle your portfolio.
Absolutely. On that note, Pranjal, thank you so much for sharing your thoughts and talking with us today. Thank you.
Pleasure, Tanya. Thank you for inviting me. Bye.